The images coming out of the UAE this week are something the global financial markets never priced in. Scorch marks on the Burj Al Arab, emergency sirens drowning out the call to prayer in downtown Dubai. The retaliation strikes from Iran following the US-Israeli Operation Rising Lion have done more than damage infrastructure. They have pierced the invisible shield that made Dubai the only safe harbor in a volatile region. This is Meridian Intelligence. For decades, the unspoken contract was simple. The Middle East burns, but Dubai builds. While Beirut collapsed and Baghdad burned, Dubai put up another tower, opened another free trade zone, welcomed another wave of billionaires, bankers, and builders. Capital fled to here, not from here. But today, with the Strait of Hormuz blocked and insurance premiums for tankers hitting war risk levels not seen since the 1980s, that contract is void. We are witnessing the start of the 2026 capital flight paradox, where the city built to absorb the world's fear is now generating it. Let's look at the logistics first. Jebel Ali Port is the 9th busiest port in the world and the largest in the Middle East. Every year, it handles over 14 million container units. It is the reason Dubai can import 90% of its food, the reason its hospitals have medicine, the reason its construction sites have steel. With the port suffering direct strike impacts and the strait acting as a complete chokehold on maritime traffic, supply chains aren't just disrupted, they are severed. The cost of shipping a single container from Shanghai to Dubai has jumped 400% in 72 hours. Freight forwarders are diverting cargo to Oman, to Saudi Arabia, to anywhere with an open route, but those alternatives add weeks to delivery times and lack Jebel Ali's capacity. The city has roughly a 3-week buffer of food and essential goods before shortages become a political crisis. This isn't inflation, this is strangulation. Then there is the real estate market, the engine of Dubai's wealth. In 2025, we saw record inflows. Russian oligarchs, European family offices, Indian industrialists. The Palm Jumeirah, downtown, Dubai Hills. These weren't just luxury purchases, they were strategic relocations of generational wealth. Today, those same investors are freezing. Brokers are reporting a total halt in transactions. Lloyd's of London has suspended new property coverage within 15 kilometers of the coast. The luxury villas on the Palm, once the ultimate hard asset in a dollar-pegged, tax-free environment, are now uninsurable liabilities sitting in the line of fire. But here is the twist. History tells us that smart money doesn't panic, it waits. We saw this in Kuwait after the Gulf War, in New York after 9/11, in the region surrounding Kyiv after 2022. The tourist money leaves first, the retail investor follows. But the institutional money, the sovereign wealth funds, the family offices with 50-year horizons, they are watching one thing right now, not the missiles, the US naval response. Because if the Fifth Fleet clears Hormuz within 30 days, Dubai doesn't just recover, it consolidates, absorbing capital from investors who couldn't stomach the volatility. The broader question is what analysts are calling the safe haven premium. For 40 years, Dubai charged an invisible fee to global capital. Zero tax, zero conflict, total stability. In return, it got everything. The deposits, the headquarters, the talent, the trade flows. If Dubai can no longer guarantee physical safety, does it lose that status to Singapore, to Zurich, to Abu Dhabi, which, notably, has not been struck? The dirham is pegged to the dollar and that peg will hold. But the real economy is not pegged to the dollar, it is pegged to confidence. And confidence is not a monetary instrument. You cannot print it. You cannot inject it through a central bank. Once it evaporates, the liquidity crisis will hit local banks within weeks. Now zoom out, because this is bigger than one city. This war is about the $1.2 trillion of trade that passes through these waters every single year. Oil, gas, electronics, grain, pharmaceuticals, car parts, the arteries of the global economy running through a strait 33 kilometers wide at its narrowest point. If the closure of Hormuz lasts more than 2 weeks, we are looking at $150 oil, jet fuel prices that ground airline routes, shipping costs that empty shelves across Europe and Asia, and a global recession that makes 2008 look like a correction. The bond markets are already moving. Gold is up. The world isn't panicking yet, but it is repositioning. And repositioning at this scale and speed is the early warning sign that panic is not far behind. Dubai is the canary in the coal mine of global finance, the city built to never flinch, the market engineered to stay open when everything else closes, and right now, the canary is choking. The question is not whether the world is watching, the question is whether the world is ready for what comes next, if this doesn't get resolved in time.